Hello everyone, how are you all? Welcome back to my channel. I hope everyone is doing great. I am also absolutely fine. Today in this video, we will be discussing the solution for descriptive part of corporate financial reporting paper of CMA Final for the exam held in December 2025. Already we have discussed all the solution of MCQ questions, multiple choice question. The video, if you have not listened that, the link of that video is given in the description of this particular video. Before I start the descriptive solution discussion, let me just inform you one important message for the student appearing for June 2026 and onward attempt. All my free resources of corporate financial reporting I have uploaded in my channel. I have two channels, one is Telegram channel, one is WhatsApp channel. You can join both the channel. The link of that channel is given in the description of this particular video. What you will get in my channel? You will get all the free resources coming to one by one. You will get my India Saransh book completely freely available for CFR, the concept book you can say. Okay, all the concept of India has been given in such a way that you can revise just before exam. Second, you will get the suggested solution of December 2025 exam, whatever I will be discussing right now. You'll get the MCQs, all the multiple choice question, whatever has been asked in past year examination as well as in MTP, all has been incorporated in one PDF. You can download that for your MCQs preparation. Then my regular batch class note you can download, and if you have any doubt about any question, you can just refer it. Okay. Summary handwritten notes of important chapter. It is in my handwriting. Believe me, it will really help you to revise all the important chapters. CFR test series coming soon. For that test series, you need to join my channel. Okay. Expected question for June 2026 coming soon. Very important. Join my channel for that. You can see all the free resources will be available. With that, you will also get the link of demo lecture if you want to join my batch, and also the registration link will be also provided. With that, I have also opened one free CFR mentorship group. It is freely available. Join that WhatsApp group. In that, I will answer all your query, even though you are not my student. Correct? So join that group. It is freely available for all the students, whether you have taken my class or whether you have taken classes from any faculty. You can ask any question of CFR in that. I will guide you regarding that question. That is my commitment. Okay. I hope these free resources will really help you. Now let us start the discussion of descriptive part of CFR question paper. Let us start with the question number 2A. Why question number 2A? Because question number 1 was MCQs already discussed. What is the first question? First question related with Ind AS 12 income tax. Very good question. Ketan Limited has a block of asset with a written down value of 15 lakh on 1st April 2023 for tax purpose. Means that tax base, opening tax base is given. The carrying amount of the asset for accounting purpose is also 15 lakh. Means carrying amount is also given, and carrying amount of tax base opening is same. Depreciation is charged at a rate of 20% per annum as per diminishing balance method for accounting purpose, and the same rate per annum on written down value for tax purpose. Means rate of depreciation was also same. Of the entire block, asset with the carrying amount of 1,50,000 for both accounting and tax purpose on 1st April 2023 were sold for rupees 3 lakh on 31st March 2025. Means one asset whose book value at the beginning means on 1st April 2023 was 1,50,000 was sold on 31st March 2025 for rupees 3 lakh. Only this was the changes, and because of that reason there will be some difference between tax base and carrying amount. Based on above details, you are required to compute the deferred tax asset or liability as per Ind AS 12, assuming tax rate is 35%. Believe me, this question is not given in the institute book, but similar question we have taken in the class. If you have taken my class, I hope you'll have done this question correctly. Okay, let me explain. So you can see this is the PDF where I have already incorporated all the solution. You can download this PDF from where? From my either WhatsApp channel or Telegram channel. I will suggest you join both. Okay, yes sir. So first we'll find out working note. One is for calculation of carrying amount of the asset. So WDB at the beginning is 15 lakh. Depreciation of 23-24 will calculate at what rate? 20%. It is given. You can check 20%, 3 lakh. Then again depreciation of second year 2,40,000. But can you say At the end of the year, one asset was sold whose carrying amount at the beginning was 1,50,000. KNC will charge depreciation for 2 years on that because we need to deduct WDB of that asset as on 31st March 2025. We can say 1,50,000 into 80% into 80%. This becomes the carrying amount of that asset at the end. So 96,000 deducted and this becomes the carrying amount of asset as on 31st March 2025. Correct? Now we'll calculate tax base. Tax base means as per Income Tax Act. So opening tax base given, depreciation of first year, it is coming 12 lakh. Will this become tax base at the beginning of second year? Now, as per Income Tax Act, it is a first we'll calculate depreciation and after that we'll deduct from the block the sale proceed of the asset. Sale proceed, not the carrying amount. Understood? It means depreciation is what? 2,40,000. And then we deduct the sale proceed, that is 3 lakh, and this becomes a tax base. The remaining amount will become a tax base of that block. So 6,60,000 is the tax base as on 31st March 2025. Now we'll compare carrying amount and tax base at year end, means at 31st March 2025. So carrying amount is this, tax base is this, and you can see the carrying amount is more than tax base. It means there is a taxable temporary difference. On that we'll calculate DTL. So DTL at the rate of 35% on 2,04,000 will be 71,400. This is the answer. Chalega? Understood? Yes, sir. Let us come to the next question. Question number B, 2B. On 30th Jan 2024, Raju Limited purchased a machinery for $15,000 from an USA supplier on credit basis. So machinery was purchased in foreign currency from a supplier on credit basis. It is a question of Ind AS 21, the effect of changes in foreign exchange rate. Correct? The first currency of Raju Limited is Indian rupee, of course. The exchange rate on 30th Jan is $1 is equal to 60. The fair value of machinery is determined on 31st March 2024 is $16,500. So of course, if the fair value is given, it means they have opted for revaluation model. The exchange rate on 31st March 2024, when the fair value was determined, that time it was $1 is equal to 65. Okay. The payment to USA supplier was made on 31st March 2025 and the exchange rate on the date of payment was $1 is equal to 67. The fair value machinery remain unchanged, means for the next year the fair value remain unchanged. The tax rate is 30%. Now whenever tax rate is given, once again we should think about deferred tax. Raju Limited allow revaluation in respect of plant and machinery. Based on above, you are required to pass journal entry. Narration not required. Thank you very much. For the year ended 31st March 2024 and 31st March 2025 as per Ind AS 21. Chalega. Good question. Let us come to solution. Now you can see question number 2B, answer has been given. The first journal entry will be done on 38th January 2024. Journal entry will be PP account debit payable, and as per Ind AS 21, any foreign currency transaction will be translated by using transaction rate exchange rate. So on that date, what is the exchange rate given? $1 is equal to 60. Therefore, 15,000 will be translated at 60 rupees per dollar. 15,000 into 60 is equal to 9 lakh. Journal entry has been done at 9 lakh. Now, out of this, you can see PP is foreign currency non-monetary item and payable is foreign currency monetary item. This is foreign currency monetary item. This is foreign currency non-monetary item. Now, as per Ind AS 21, if there is any foreign currency monetary item, it will be translated by using closing exchange rate on reporting date. Correct? You can see what we have done on 31st March 2024. We have translated payable by using closing exchange rate, that is $1 is equal to 65. The payable will increase from 60 to 65. There is an exchange loss of rupees 5 per dollar. Therefore, we have done one journal entry, exchange loss to payable with 75,000. Chalega? Yes, sir. Now, foreign currency non-monetary item, if carried at cost, no translation required. But in this question, it is carried at fair value and therefore need to be translated at a rate when the fair value was determined. The fair value was determined on 31st March 2024. Fair value has been given 16,500 multiplied by 65. So what is the fair value at current Indian currency is equal to 10,72,500. What is the carrying amount? Carrying amount is 9 lakh. Therefore, total gain is 1,72,500. You can see we have ignored depreciation of machinery. Why? Because the rate of depreciation as well as useful life has not been given. Because the information has been not given, we have ignored depreciation part. Okay, sir. Yes, sir. You can see the total gain is 1,72,500, but out of this gain, some gain is revaluation gain and some gain is exchange gain. What is the revaluation gain? Revaluation gain will be 16,500 minus 15,000, that is 1,500 multiplied by 60, that is 90,000, and the balance gain means it is nothing but 1500 16,500 multiplied by 5, 16,500 multiplied by 5 is the balance gain, that is nothing but exchange gain. Now as per India's 21, if there is a foreign currency non-monetary item and that is actually translated, then in that case, if the revaluation gain or loss has been transferred to PL, then exchange gain or loss will be also transferred to PL. But if the revaluation gain or loss is transferred to OCI, then your exchange gain and loss will be also transferred to OCI. Means in this case, both revaluation gain and exchange gain will be transferred to OCI and accumulated in revaluation surplus. Therefore, we have done one compound journal entry, PP account debit to OCI revaluation surplus with the amount 1,72,500. However, you can do the separate journal entry also. Chalega? Yes, sir. Now, because the tax rate is given, India's 12 will be applicable, and India's 12 says that due to revaluation gain, there will be some taxable temporary difference on which DTL will be recognized, and DTL will be also created through OCI. Therefore, we need to recognize DTL through OCI. Journal entry will be OCI account debit DTL on what amount? 1,72,500 multiplied by 30%. This will be the journal entry. Now coming to the next year, 31st March 2025 year end. It is a payable will be settled. Once again, payable will be settled by using the closing exchange rate, and the closing exchange rate is given how much? $1 is equal to 67. The payable already recorded at 65. Payment we have received at 67. Once again, there is a loss of 2 rupees per dollar, and that loss will be transferred to profit and loss account. Then on 31st March 2025, once again, because the fair value information has been given, so fair value need to be changed at current exchange rate. So now the exchange rate is 67, 16,500 into 67. This amount will come. Carrying amount means the carrying amount is previous fair value, that is 10,72,500. So 10,72,500, and this become exchange gain. Once again, this exchange gain will be transferred to OCI accumulated in revaluation surplus, PP account debit to OCI 33,000. And on this gain, once again, there will be some taxable temporary difference. Once again, we need to recognize DTL, and DTL will be 33,000 into 33%, that is 9,900. Journal entry will be OCI to deferred tax liability. Okay, sir. That good question. The same question was actually in CA Final. This question has been taken from CA Final syllabus. Okay, sir. Okay. Now, let us come to question number 3. This question is from India's 108. Very simple question. I think in this no doubt should come. What they are saying? An entity operates through 8 segments, namely A, B, C, D, E, F, G, H. The relevant information about this segment has been given below. Segment revenue is given, external sale is given, inter-segment sale is given, segment result is given, segment asset is given. No additional segment has been identified by the management as per discretion. Identify the reportable segment as per Ind AS 108. So can you see in this you need to first apply QT criteria. Now after apply QT means quantitative threshold criteria based on segment revenue, segment result and segment asset. After that you need to also apply entities revenue criteria, 75% entities revenue criteria. Okay, let me give the answer. The answer I hope you can understand by this solution only, but let me explain. First, we'll prepare identification of a reportable segment based on quantitative threshold criteria. Correct? You have written all the segment total based on segment revenue. So we need to find out external sale plus internal sale. This becomes segment revenue. Now, of course, based on this, we'll find out percentage to total segment revenue. Now, if the percentage is 10% or more than 10%, it will be identified as a reportable segment based on segment revenue. So this is reportable segment. This is reportable segment. Okay, sir. So based on segment revenue, A and B are reportable segment. Now coming to based on segment results. So first we need to find out profit. We need to find out result in terms of profit total, then result in terms of loss total. So you can see we have first calculated result in terms of profit, the result in terms of loss, and the higher of this will be taken as a benchmark. So higher is 100. Now we'll calculate the percentage to total loss, percentage to total loss. So you can find out the percentage total loss means 5 by 100, 90 by 100 like this, and you need to find out now percentage. If the percentage is 10%, more than 10%, it will become a reportable segment. So you can see B is reportable, C is reportable as per what segment result. Okay. Now coming to segment asset, once again you will find out segment asset, total segment asset. You will find out percentage total segment. You can easily find out. Now, once again, if the segment asset is 10% or more than 10% of total segment asset, that become a reportable segment. So this is a reportable segment. This is a reportable segment. So here, this is also reportable segment. A, B, and D is reportable segment. It means as per all these three criteria, A, B, C, D will be reportable segment. A, B, C, D are reportable segment based on the quantitative threshold criteria as per Ind AS 108. But now we need to apply revenue criteria. What Ind AS 108 say that if the external say reported by reportable segment should constitute at least 75% of entity's revenue. What is the entity's revenue? Entity's revenue means external sale total. That is given how much? How much it is given? 400. We'll find out a 75% of this 300. But A, B, C, D. If you make total of A, B, C, D, these 3, so it will come how much? It is coming only what? 280. It means this criteria is not satisfied. Therefore, additional segment need to be identified so that at least 75% of entity's revenue is reported in reportable segment. And therefore, by our choice, we have identified in the given case additional segment that is given, and segment F. Why we have chosen F? Because F has higher segment sale as compared to other segment. So F having higher external sales will be identified as reportable segment so that external say reported will now become 82.5% of entity's revenue. Hence A, B, C, D and F are reportable segment. Correct? From my point of view here, if you have missed this particular point, some marks will be deducted from your exam marks. Okay? Yes, sir. Done. Now let us come to the next point. 3B. Now next question is question number 3B. This question related to valuation of equity shares. The following is the balance sheet of ABC Limited as on 31st March 2025. You can see asset has been given, non-current asset, PP, financial asset, current asset. You can read the balance sheet. Okay. Yes, sir. Now in this one non-current liability, point number B, other financial liability is given, and in that they have given cumulative preference here. So whenever cumulative preference is given and that is given the liability, that has been classified as liability, not capital, not equity. You can see they have given authorized, issued, subscribed and fully paid up 4,20,000 equity shares rupees 10 each and 5,60,000 equity shares rupees 10 each rupees 6 paid up. It means we have same class of equity share with different paid up value. Okay. Yes, sir. Retained earning has been given, deficit balance with debit balance has been given. The other piece of information are as under. Current cost of PP is given 104.16 and that of stock is given 28 lakh. Investment could fetch only 2.8 lakh, means this become the market value. 50% of trade debtor are doubtful. Preference dividend was in area for the last 5 years. Now for any liability there is some area, so can you see we need to recognize it as a what? Expense payable. So this will be preference dividend payable, need to be recognized for how many years? 5 years. Based on above details, you are required to compute the value of an equity shares of ABC Limited on net asset basis, means intrinsic value method. Come to the solution. Correct. So first we'll calculate what? Net asset available to equity shareholders. For that you will take all asset at fair value. So PP has been taken at fair value. Investment has been taken at fair value, means current cost. Inventory has been taken at current cost. You can see trade receivable after doubtful debtor, means we have deducted doubtful debtor. It is coming 5.60. Cash and cash equivalent has been taken. Then total liability borrowing will be taken. 9% cumulative preference shares has been taken because that is a liability. In also we'll also calculate accrued preference dividend, means preference dividend payable for how many years? 5 years. So 16.80 into 9%, that was rate of dividend, and into 5. This was a special point. Then trade payable will also come. This is the total liability. This is the net asset available to equity shareholders. Now we need to add notional call. Notional call will be 5,60,000 into 4. This will be notional call. This become the total net asset available to equity shareholders after notional call. Now divided by number of equity shares. Number of equity shares what? 4 lakh 20 plus 5 lakh 60. So that is 9.8 lakh. 9.8 lakh. So this become intrinsic value fully paid up. Now 9 minus what? 4. That will be intrinsic value partly paid up. So intrinsic value partly paid up will be 5. Chalega. Good question. Understood. Now let us come to the next question. Next question is question number 4A related to Ind AS 109. That is for financial liability. So Rakesh Limited borrowed and rupees 18 crore 75 lakh from Central Bank of India on 1st Jan 2024. The term loan were as under. Interest rate was 11% per annum. Repayment of principal in 5 equal annual installment means 18 crore 75 lakh divided by 5. Okay. Payment of interest annually on accrual basis. Upfront processing fee, so there is some transaction cost. So this transaction cost will be deducted from the proceed to find out the net amount. Means initial recognition will be done at fair value minus transaction cost. The effective interest rate is given 11.50. Of course, whenever there is a transaction cost, there will be some effective rate of interest. Based on above details, you are required to prepare the statement showing the amortization loan based on effective interest rate for a period of 5 years. Okay, sir. Past journal entry narration not required in the books of Rakesh Limited for availing loan from bank on 1st Jan 2024 and for payment of first installment of loan and interest on 31st December 2024. Simply speaking, 1 year journal entry they have asked. Now, whenever question is silent, always will assume that contractual rate of interest is as per market terms. It means, can I say market rate of interest and contractual rate of interest are same, and therefore whatever proceed has been received, that will be the fair value. The initial recognition will be done at fair value minus transaction cost, and subsequent recognition will be done at amortized cost by applying EIR. Chalega. Now let us come to the solution, and you can see in the solution already I have mentioned the initial and subsequent recognition. But first we need to find out what is the contractual cash outflow. That will be principal plus interest calculated at contractual rate of interest, that is 11%. Already I have calculated principal to 18 crore 75 lakh divided 5, to each it will be 3 crore 75 lakh. Interest will be calculated on diminishing balance at a rate of 11%. That is also calculated. You have calculated, just check it. So this is the amount of contractual cash outflow. I hope here you might have done mistake because the amount is in crore. So it is a big amount. Sometimes what happens, bigger amount in exam, your mind will not work. So I hope you might have done mistake here. Now the first part we need to calculate amortization cost table at if by applying effective rate of interest, and effective rate of interest 11.50. So of course opening liability will be what? Opening liability already we calculated 18 crore 75 lakh minus processing fee, that will be 18 crore 52 lakh 98,714. So that become opening liability. Interest 11.5% contractual cash outflow as per previous working note. This will be the closing balance, and of course you can work out. Then journal entry is very simple. The first journal entry is bank account debit to financial liability at fair value minus transaction cost. Then second journal entry at year end interest expense account debit to financial liability. Then third journal entry is financial liability account debit to bank with the contractual cash outflows. Super easy. Done. I hope you are understanding each and every solution. Now let us come to the next question. Next question is question number 4B. The question is related to internal reconstruction. Question was good question. The summarized balance sheet of BEAS Limited as on 31st March 2025 is given below. You can see the balance sheet has been given. You can read. The notes to account has been given. In the notes to account, they have given authorized, issued and fully paid up 1,80,000 equity shares and 8,008% preference shares of rupees 100 each. Other equity has been given. Long-term borrowing, there are two class of debenture, A and B class. A is secured by the asset of Uttarakhand factory and B is unsecured. Short-term borrowing has been given. Okay, you can read it. Intangible asset, we have goodwill and patent and copyright. Due to heavy losses and overvaluation of asset, the following scheme of internal reconstruction was framed. What is the first point? Preference holders would sacrifice 25% of their claim and they would be allotted 9% new preference shares for the remaining amount. So of course, there is a reduction of 20% and for the balance, they will get 9% new preference shares. Correct? Now, this was point number 1. And there was one point number 4. The paid up value of equity share would be reduced to 6 per share. You can see the paid up value of equity shares would be reduced to 6 per share. Means in this case, face value remain unchanged. Means this is a reduction of paid up capital without changes in face value. So for this, what journal entry will do? Equity share capital to capital reduction. You can see the solution. Equity share capital to capital reduction, and the amount will be 7,20,000. Means 1,80,000 was the number of shares reduced. 2 rupees 6 means reduction is rupees 4, reduction by rupees 4, so 1,80,000 into 4. Now second journal entry I have done for point number 1, preference share capital, the old preference share capital to new preference share capital, and the difference will be transferred to capital reduction. So capital reduction will be 20% amount. You can see the same journal entry we have done. Okay, I think in this no doubt. Then what is given? A class debenture holders having a charge on plant and machinery of Uttarakhand factory would accept plant and machinery in full settlement. So they will take plant and machinery in full settlement. Unsecured debenture holder agree for 20% reduction and the remaining amount is to be converted into 9% preference shares or rupees 100 each. Means A class debenture will take plant and machinery for full settlement. Okay. The plant and machinery of Uttarakhand is how much? 8,50,000. What journal entry will do? Debenture account debit to plant and machinery, and the difference will be transferred to capital reduction. What was the amount of debenture? 9 lakh. 9 lakh minus 8,50,000. The 50,000 will be the amount of capital reduction. Same journal entry we have done. You can see 8% A debenture to plant and machinery to capital reduction. Now for B debenture, what they have said, they will reduce 20% and the balance will be converted into new class of preference share. Okay, sir. So debenture account debit to new class of preference shares to capital reduction, that is 20% amount. So that is also given. You can see the same journal entry has been done. This was also very easy. Can we come to next point? Yes, sir. Then they've given trade credit agree to take over the stock up to a value of 6,20,000. So trade credit will reduce and they will take a stock of value of 6,20,000. So trade creditor account debit to stock. Stock means inventory 6,20,000. That journal entry has been done. Okay, sir. Yes, sir. Then coming to next point, an amount of 60,000 was receivable against loans advance. So amount of 60,000 was receivable. Now what was the amount of loans and advance? It is given. You can see how much amount has been given for loans advance. 77,000, but only 60,000 receivable. Means 17,000 reduced. So we need to reduce loans advance by 17,000. Okay. Yes, sir. Then trade receivable remaining stock would be valued at 90%. It means we need to reduce trade receivable by 10% and the remaining stock. The remaining stock is how much? What was the total inventory? Total inventory is how much? 13 lakh. Out of that, 6,20,000 was taken by debenture A class. The balance stock will be reduced by 10%. Okay. Yes, sir. Then coming to directors would forego their loan in full. The directors would forego their loan in full. So for that, what journal entry will do? Director account debit to capital, directors loan account debit to capital reduction. I think first journal entry I have done that. Loan from director to capital reduction, entire amount will be transferred to capital reduction. Then what journal entry we have done? Capital reduction account debit to trade receivable by 10%. Inventory, the balance inventory by 10% is 13 lakh minus 6,20,000 into what? 10%. Into 10%. Then can I say that they have also given one more point, patent and copyright and goodwill had no value. Had no value means fully written off. You can see fully written off. So we have written off patent and copyright with full amount, goodwill by full amount, and loans and advance by 17,000. Already I have discussed. And PL debit balance is given. Retained earning debit balance has been given 7,80,000. That will be also written off. The total amount will be this amount that will be debited to capital reduction account. Then we'll find out the closing balance of capital reduction account, which will come 47,000. That will be transferred to capital reserve at the end of internal reconstruction scheme. So one last journal entry, capital reduction to capital reserve, that is 47,000. Okay, sir. Easy. Now coming to the next question. Next question is question 5 related to business combination. Simple question but good question. Okay. It is given. On 1st April 2025, Alpha Limited acquired 100% equity shares of Beta Limited. The consideration was discharged by issue of equity shares of Alpha Limited. The summarized balance sheet of the company as on 31st March 2025 is given. You can see simple balance sheet has been given. Additional information point about PC was settled by issuing 80 lakh equity shares of rupees 10 each issued at a premium of rupees 2 per share to the shareholders of Beta Limited. This is the fair value of equity shares issued, will be used for calculation of PC. Alpha Limited also agreed to pay contingent consideration of 50 lakh payable after 2 years. This will be added to PC at fair value on the date of acquisition, and fair value on the date of acquisition was given 40 lakh. Fair value beta limited assets and liabilities given PP 90 950 lakh, investment 280, trade receivable 190, 10 lakh is considered doubtful, that will not be considered. Trade payable 500 lakh, investment nil. They were intercompany balance. Alpha Limited had a receivable of 20 lakh from Beta Limited appearing in Alpha Limited trade receivable. It means Alpha trade receivable is Beta trade payable. This is intercompany balance. This is the point of discussion. I'll discuss this point. Okay. Expense related to the issue of shares amounted to rupees 12 lakh debited to bank account. If you remember, Ind AS 103 says that any cost of issuing shares will be accounted as per the requirement of Ind AS 32, and as per Ind AS 32, any transaction cost of equity will be deducted from equity. Correct? It means for this we can pass journal entry either securities premium account debit to bank or retain earning account debit to bank, whatever your choice is. You are required to compute the PC. PC need to be calculated. Compute the net asset of Beta Limited at fair value. Calculate goodwill or gain on bargain purchase. Pass journal entry. Narration not required. Means they have not asked balance sheet. Now only this point will change your answer. What you are understanding about this point. Now if you remember, as per Ind AS 103, what Ind AS 103 says about PC calculation, that if there is some separate transaction which is not a part of business combination transaction, should be adjusted with the amount of PC to calculate PC for business combination. Now, due to any pre-existing relationship, if there are some receivable in the books of acquirer or payable in the books of acquirer to acquiring company or from acquiring company, so that need to be adjusted. Correct? Now just try to understand. Suppose PC for business combination, let's say PC for business combination 100 lakh, and you have a trade, means acquirer has a receivable from acquiring before business combination transaction. So of course, can I say they will pay what? 100 is payable, 20 is receivable, means PC agreed, means as per agreement PC should be 80. Means as per whatever they are paying, that is 80. If you want to calculate 100, you will add 20, and this is PC for business combination. Understood this point? Now what is your viewpoint? Means from my point of view, this is 100% correct, but some of the teacher or some of the faculty or I don't know what institute will think about this point. If they are cancelling this trade receivable and trade payable separately, then your entire solution will change. So I'll give you two solutions. I don't know what institute is thinking from point number 4 point of view. From my point of view, as per business combination, this point need to be adjusted while calculating PC for business combination, as well as net asset will be also adjusted, and entire calculation will change. But if you consider it as a separate cancellation transaction, then your answer will be different. So what I have done, I have given you two answers. I don't know what institute will do about this particular point. What you have done about this particular point, that I also don't know. But I will give you my answer. Let's see what institute is giving their solution. Okay. First, I have assumed that this trade receivable means pre-existing relationship is adjusted with PC for business combination. What is the fair value of equity shares issued? 80 lakh into 12. It is issued at a premium. You can see the shares were issued at 2 rupees premium. So 10 plus 2, 12. So it will be 960 lakh. Then fair value of contingent consideration given 40. So it become 1000 lakhs. And because there was a trade receivable, that will be added. The pre-settlement of pre-existing trade receivable 20. So PC for business combination will 1020. Okay. Now calculation of INA at fair value. Calculation of INA at fair value. So PP has been given, investment has been given, nil, inventory has been given, trade receivable has been given, cash and bank will be taken at carrying amount, and trade payable. While calculating trade payable, because trade payable of acquiring company will include that intercompany balance, that will be deducted. That will be deducted because that will not be taken over now. So 500 minus 20, this was a special point. This become INA at fair value. So your answer will change. What accounting you are doing? Got this point? Yes, sir. So abhi right now I don't know what is the institute solution. I'll give you both the solution. Okay? Chalega. Then calculation of goodwill or gain on bargain purchase. So in this case, PC is how much? 1020. Fair value of INA is how much? 1040. So there is a gain on bargain purchase 20. Your goodwill or gain on bargain purchase will remain same in both alternative solutions. So whatever you are taking, your gain on bargain purchase will be 20 only. Now what will be journal entry? Journal entry will change thoda sa. So INA account debit 1040. You can write on all assets and liabilities separately. I am writing INA. Okay. INA account debit 1040 to consideration payable 1020, and the difference will be gain on bargain purchase, which will be transferred to capital reserve. Then consideration payable to equity share capital 800, to securities premium 160 because 2 rupees was premium, and to fair value of contingent consideration will be recognized as provision for contingent consideration. To provision for contingent consideration is 40, and you can see the difference will be 20, and trade receivable in the books of acquirer will get cancelled. We run 2 trade receivable because that will be cancelled now. Understood? Yes, sir. Now for payment of the cost of issuing equity share, we'll do either securities premium account debit or retained earning account debit to bank. Both are correct. Whatever you want to write down. Chalega. This is the answer. First alternative answer. Coming to second alternative answer, you can see in this case, I have not adjusted that pre-existing relationship to calculate PC amount. I don't know what institute will take. Okay, yes, sir. So fair value of equity shares issued is 960. Fair value of contingent consideration 140. The total PC is 1000. So your PC will be different. From my point of view, first alternative is the best answer. Okay, yes, sir. Calculation of INA will change. Now your INA will be 1020. Why? Because now trade payable will be 500 because that will be separately cancelled. Then calculation of goodwill or gain or bargain purchase. You can see your gain or bargain purchase remains same. Now first journal entry, of course, this amount will change. Now INA is 1020, consideration payable is 1000, and gain on bargain purchase 20. Once again, consideration payable 1000, equity share capital 800, securities premium 160, and provision for contingent consideration 40 because trade receivable will be separately cancelled. Correct now. So you can see this INA include that trade payable of 20, and trade receivable is already appearing in the balance sheet of acquirer company. So we are separately cancelling trade payable account debit to trade receivable 2020. And of course, this cost of issuing equity shares, securities premium account debit to bank. I hope this too you have understood. Chalega. So these are the two alternative solutions what I have understood. From my point of view, first answer is more appropriate because they have asked you separately PC calculation. So this is the best answer. Okay, so what you have done, option number 1, alternative number 1, alternative 2, just comment in the comment box. Let me see what you have done. Okay, sir. Done. Now let us come to next question. Next question is question number 6. Related to consolidation. The balance sheet of H Limited, S Limited as on 31st March 2025 were as follow. You can see the balance sheet has been given for H Limited, S Limited, rupees in lakh has been given. Yes, sir. Additional information. On 1/4/2024, S Limited had 800 lakh shares or rupees 10 each and 6,000 lakhs in his retained earning in other equity. It means so opening balance or retained earning has been given. H Limited acquired 80% shares of S Limited on 1/4/2024, means at the beginning of the year, at a consideration of 11,600 lakh payable in cash. So it means they have given the cost price of investment. Let's see, investment is coming 11,600 only. Okay, yes, sir. It means there is no other investment. In addition, H Limited also acquired 60% debenture issued by S Limited in cash on 1/4/2024. You can see the debenture of S Limited is 4,000. 4,000 into 60%. So it means they have acquired debenture of how much nominal value? 2,400 nominal value at rupees 2,500. It means the nominal value of the debenture acquired is 2,400 and the cost price is 2,500. If you remember, this is intercompany borrowing, will be cancelled, and you can see they have paid higher amount. How much higher amount they have paid? 100. That will be loss on cancellation, debited to consolidated retained earning. It will be loss on cancellation. When you will calculate retained earning, consolidated retained earning, then it will be deducted. Okay, sir? Yes, sir. Chalega. The aggregate INA of S Limited as on 1/4/2024 included PP and inventory standing at a book of S Limited 5,000 lakh and 1,000 lakh, means the book value of PP and inventory has been given. having a fair value of 5,600, 400 lakh respectively, and fair value has been given. This is for fair value adjustment. The rate of depreciation on PP is 10% per annum. The rate of depreciation has been given. NCA was measured fair value at par value basis. Means I have found some problem in this. Why the problem arise? Because when I am saying NCA was measured fair value at par value. Par value means at face value. At face value. But when we are using face value for measurement of NCI, in that case, goodwill is not coming. If there is no goodwill, the question of impairment will not arise. But in the next point they have given, goodwill was impaired by 200 lakh. So this will be against the question. If there is no goodwill, how there can be impairment loss of goodwill? And therefore, from my point of view, it is par value or per value. One doubt will come. When I am saying at par value, it means at face value. When I am saying per value basis, per value means what? Per value of shares. Then it means the NCA is measured proportionately based on the value of purchase consideration. So it means here also there are two viewpoints. Correct? As per the question, it is at par value, and from my point of view, most of the student has taken face value only, but in that case, goodwill will be zero. Means in that case, gain on bargain purchase will come. So if there is no goodwill, the question of impairment should not arise. But point number D is given, goodwill will be impaired by 200 lakh. So why this point has been given? Got this point? If I will take per value basis, so it means it is calculated as per the per value of shares basis. We need to first find out value per share based on the PC calculation. So PC, total PC will calculate, divided by number of shares, so we'll get the per value of shares, and that can be used to find out NCA measurement. In that case, goodwill is coming. So 1 second, 2 assumption. So I have given answer both as per both assumptions. From my point of view, as per the question, we should take face value. If I am a student to an exam, of course, my mind will not work and I will go as per the question only. Na? Chalega, yes, sir. H Limited sold goods worth rupees 200 lakh to S Limited on a credit at a profit of 20% on sale. So H Limited sold goods worth rupees. So of course, this is sale price and 20% on sale. And therefore, URP, unrealized profit, will be how much? 200 into 20%, that is 40. And for 50% of goods were still lying unsold, so that is 50%. So your URP to be cancelled is 20. And because this is downstream transaction, your journal entry will be retained earning account debit inventory. Means you will decrease your retained earning and your inventory will also decrease. Yes, sir. Then on 1/4/2024, H Limited sold an item of PP worth rupees 400 lakh to S Limited at a profit of 25% on cost. Oh my God. H Limited sold an item of PP worth rupees 400 lakh to S Limited. 1 second, this is sale price at a profit of 25% cost. So 25% cost. Correct. It means 25 by 125 of sales. So it means what is the profit? 400 into 25 by 125. So 80 is the profit, which is unrealized profit. So that need to be also eliminated. To eliminate that, because that you can see the PP is still included in the balance of PP in S Limited, that remain unsold. You need to eliminate that. What journal entry will do? 1 second, this is downstream transaction, retained earning account debit to PP. Retained earning account debit to PP. Correct. But can I say on this PP, can I say S Limited has also calculated depreciation? So they have calculated depreciation on 400 and 400 include URP, which is getting cancelled. It means, can I say, whatever extra depreciation on 80 has been calculated by S Limited, that need to be also cancelled. Correct. It means we need to decrease the depreciation amount. If you are decreasing depreciation amount, it means you need to increase the profit of S Limited, and therefore one more journal entry will do PP account debit to profit of subsidiary company. Profit of subsidiary company, or you can say depreciation expense of subsidiary company. Got this point? It means there are two cancellation. One is the cancellation of unrealized profit. One is the cancellation of extra depreciation charged by S Limited on unrealized profit part. Okay, sir. Yes, sir. Very good point. This is for the first time they are asking this type of question in CMA exam. Interest on debenture is payable on quarterly basis. Last quarter interest is still outstanding. Last quarter interest still outstanding. Is not paid. Not paid means it will come in the balance sheet, and you can see interest, neither interest payable is coming in the balance sheet of S Limited because on debenture, and there was investment, so there should be interest receivable, that is also not appearing. So we need to record it. It is an error in the books of subsidiary company as well as in the books of parent company, that need to be recorded. Good question. चलेगा. Prepare consolidated balance sheet of group company as on 31st March 2025. So I will give you two answers based on NCI measurement. NCI will measure one measurement. Of course, it is at fair value method. So for fair value method, I will take fair value is equal to face value, or fair value is equal to value per share based on PC calculation, based on PC. Correct? Got this point? Chalega, let's do it. So coming to the solution, you can see the solution is already done. Yeah. So first we'll do fair value adjustment of PP and inventory. So fair value has been given 5,600 and 400, and book value has been given 5,000 and 1,000. There is a fair value gain in PP and fair value loss on inventory. Now for PP, can I say there will be some additional depreciation for post acquisition period, and additional depreciation will be based on 10% whatever the rate of depreciation has been given for the 1 year. So 600 ka 10%, that is 60 will come. Therefore the net amount will be 540, which will appear in the consolidated balance sheet. Now for inventory, of course, in the CMA exam, always we assume that inventory is sold during the year. So whatever inventory we acquire that is sold, so can I say because that is then cost of sales will increase. Cost of sales a post acquisition period will increase. Correct? So we'll decrease it. To reverse, we'll reverse it. So if it is minus 600, we'll do plus 600. Unsold will be 0. Unsold will remain 0. Chalega? Yes, sir. Okay. Then we'll come to analysis of profit. Closing balance is given 10,000. That is from subsidiary company balance sheet. Check it. You can see in the subsidiary company balance sheet 10,000 retained is coming. Opening balance was given additional information 6,000. Yes, sir. Chalega. So 10,000 minus 6,000. Therefore profit is how much? 4,000. There was one error. Interest payable for the last quarter has not been recorded, means for 3 months is not recorded. So we'll do 4,000 into 10% into 3 by 1200. So what is the correct profit? That is 3,900. 3,900. This will be allocated to pre and post acquisition period. Entire 12 month is a post acquisition period, therefore it has been treated as post acquisition profit, and opening balance will be treated as pre acquisition profit. Okay, sir? Yes, sir. Correct. Now from this, can I say one adjustment will do for the transaction of transfer of PP from parent company to subsidiary company. On that, there will be some additional depreciation of unrealized amount. So that will affect the profit of which company? Profit of subsidiary company. So with that amount, profit of subsidiary company will increase. You will decrease depreciation expense, profit of subsidiary company will increase. So what will be the amount of additional depreciation which was actually charged by subsidiary company? That will be on the amount of URP. So 80 was the URP, rate of depreciation 10%. So 80 into 10% is 8. So 8 will be added to post acquisition profit. Understood? So depreciation of PP sold downstream transaction 80 into 10%. So 8 will be added. So this post acquisition profit will become 3908. 3908. Understood? Chalega. Pre acquisition profit is 6,000. Now we prepare statement of net asset, date of acquisition, date of consolidation, retained earning. First we write on equity share capital. Equity share capital is given in the balance sheet of subsidiary company. Then we write on retained earning as per the previous working note. You can see 6,000 is pre. That will be mentioned on the date of acquisition column, and 3908 is the post acquisition profit that will be mentioned in retained earning is post acquisition profit. Okay. It will become 14,3908, 17,908. Then we'll do plus minus fair value adjustment. For PP is 600 minus 60. 60 is the additional depreciation. Inventory is 600 loss, and then 600 for sold inventory during the year. Chalega? Yes, sir. That will become 0. So this become the INA on the date of acquisition. This is the INA on the date of consolidation. And this it become post acquisition profit after fair value adjustment, which will be allocated to parent company NCI at 80% and 20% that can be allocated. Now we'll come to goodwill or gain on bargain purchase. Here two assumptions for NCI calculation. I have taken first assumption. Assume NCI is measured at face value. Assume NCI is based on proportionate PC. The two assumptions I have taken. So first solution, second solution based on your assumption. Of course, from my point of view, you have done first one only. But in first one, there is gain on bargain purchase. The question of that goodwill impairment wala point you need to ignore. And because of that reason, one doubt came in your mind, came in my mind, ki why impairment wala point has been given. Okay, sir. Yes, sir. So fair value consideration paid, we have calculated 11,600, 11,600. Coming to NCI as per point number one assumption. So that will be what? 800. 800 is the total number of shares. Means 8,000 divided by 10, 800. 20% is NCI. Fair value means fair value is now face value, that is rupees 10. It will be 1,600. But if we calculate based on the PC calculation, so 11,600. 11,600 is the total PC. So when I say 11,600, that is for 80%. So how much for 20%? We will do divide by 80 into 20. That will come 2,900. 2,900. Understood the difference? Difference you understood? So here it is coming 13,200. Here it is 14,500. Fair value of INA already we calculated with Sona 14,000, 14,000. You can see here gain on bargain purchase coming. Therefore, impairment loss has been ignored and the gain on bargain purchase will be 800. But here, if you see, the 500 is the goodwill. From that impairment loss of 200 and the balance 300 is what? Your goodwill. Carrying amount of goodwill which will come in the balance sheet. So two answer from my point of view. Are you able to understand what I am saying? Yes, sir. Now, other equity and NCF, first I will do assumption number one, then I'll come to assumption number two. Right now, don't see this part, okay? Don't see this part. So balance has been given. Balance has been given. Retained earning balance has been given in the parent company balance sheet. NCF we calculated 1600 as per assumption number one. Then we record interest receivable in the books of parent company. So they have what? They have also acquired some of the debentures of what? Subsidiary company. On that there will be some interest receivable that is not yet recorded. So we need to record it. So how much? 4,000. They have acquired 60%. 4,000 ka 60% is 2,400. 2,400 ka 10% into 3 by 12, that will come 60. And the balance is this interest receivable, interest payable will be cancelled to the extent of 60 rupees. To the extent of 60 rupees, and the balance will appear as interest payable in the balance sheet. Okay, sir. Are you able to follow me? Yes, sir. Then sharing profit of subsidiary company and NCI will be recorded as per Sona calculation, statement net asset calculation. Then in this case, there was no impairment loss of goodwill. Then URP on unsold stock, because that was downstream transaction, entirely deducted from retained earning. Then URP on PP sold, that was 800, because this was also downstream, entirely deducted from retained earning. Then loss on cancellation debenture, already I have said acquired at rupees 2,500, but the nominal value is 2,400. The difference will loss on cancellation deducted from retained earning. This will be the amount of retained earning. This will be the amount of NCI. Correct? If you have used assumption number two, so only the difference will come in goodwill impairment. You can see this amount will remain same, but this amount will change. NCI valuation will change. And you can see all other point remain same. All other point remains same. Only here impairment loss of goodwill come, and because it is full goodwill, will be allocated to parent company NCI at 80% and 20%. 80% and 20%, and other point remains same. This will be your retained earning and NCI as per assumption number two. As per assumption number two. And you can see I have given two balance sheet as per assumption number one and assumption number two. You can see, refer this balance sheet. You can understand. Only one point, interest receivable will be totally cancelled and interest payable will be 100 minus 60. Interest payable will come in the balance sheet in the liability side with an amount equal to 40 rupees in both assumptions. Okay, chalega. I think other point you can do by your own. Any doubt? No doubt. Okay. PP, one more point. Book value plus minus fair value adjustment. So there will be 540 because of fair value adjustment, and there was one URP. So minus URP, 80 minus 8. 8 was additional depreciation. So that need to be also taken into consideration. Correct now. So 80 minus 8. So minus 72 we have deducted. Minus 72 we have deducted. Okay, sir. Done. With this consolidation question also we have discussed. Now let us come to question number 7, 7a. It is a question of economic value added. Good question again. I will say this time they have asked good question. Consolidation question was good. EVA question was good. And also business combination, because of that point it was good question. So all questions were good. In every question there was some new point. Correct now. I can't say this was directly exactly same question whatever has been given in institute book. There was some modification done in the question. Okay. Yes sir. Alaknanda Limited, a listed company, seeks to evaluate in financial performance using economic value added metric for the year ended 31st March 2025. The following financial and market data are available. All figures are in lakhs. You can see income statement extract has been given. Net sales, operating expense excluding depreciation, interest and R&D expense. After that, they have deducted depreciation, accounting, research and development. Entire research and development have been expensed. Interest on 10%. Term loan tax rate 30% and profit after tax has been given. But for EBA, we want net operating profit after, means NOPAT. We want net operating profit after tax. Balance sheet extract has been given. Correct now. One mistake is in the balance sheet. You can see the total of equity and liability they have given 3,200 and total of total asset has been given also 3,200. But when you add these two, it will come 3,000. I don't know where 200 gone, but it will not affect your solution. It will not affect your solution. Okay. Yes, sir. Then they have given additional information, cost of capital data. They have given RF, RM, beta, tax rate. This is to calculate KE and of course KD. Tax rate has been given to calculate KD. The entire R&D expenditure of 200 lakh is considered as a capital investment asset with an estimated economic life of 4 years. The closing balance of capitalized R&D will be included in invested capital. Assume the opening balance of R&D asset was nil. Means what they are asking for economic value added, the R&D expense will be capitalized and that will be included to find out the operating capital employed. Got this point? It means some adjustment is required to calculate NOPAT and also for calculating operating capital employed. The economic depreciation to decline in the value of fixed asset for the year is 300. However, accounting depreciation is different. So this adjustment is also required to be done for calculation of NOPAT. Okay, 400 lakh was accounting depreciation. Calculate EVA for the year ended 31st March 2025. Good question. I will say good question. What is the answer? First, we'll find out NOPAT. So what I have done? PAT is given 910. We'll add tax expense that is also given. That will become PBT, profit before tax. Now in this, first we'll do adjustment for depreciation. Accounting depreciation will be added and economic depreciation deducted. Chalega. Then can you see we need to also add interest expense to interest expense. Entire interest expense has been added. Then we do also do adjustment of research and development expense. So research and development expense, so whatever was charged to PM will be added. And we do also, we need to only deduct the amortization of 200 economic life. They have been 4 year. So 200 divided by 4 means 50 is the amortization that has been deducted. Okay. So this become what? Your 1850. From that we deduct tax expense at the 30%, whatever has been rate of tax has been given, and this become what? Net operating profit after tax. This is NOPAT for EVA calculation. Now we want operating capital employed. So equity share capital has been given, other equity has been given, 10% long-term loan has been given. This is the part of operating capital employed. Correct. Now in this we need to also add capitalized value of R&D after depreciation, means 150 will be added. So 3150 will be the invested capital or operating capital employed. Okay, sir. Out of this 3150, can you say 1000 is debt and 2150 is equity? 2150 is equity. Okay, sir. Yes, sir. Now coming to the cost of capital, we need to find out WACC, weighted average cost of capital. The cost of equity, the formula is what? RF plus beta into RM minus RF. So of course you can apply this particular formula and you'll get 16% K. KD is what? KD is what? Interest and net of tax, that will be 7%. This is also very easy. You can easily calculate. Now WACC will be weighted average cost of capital. So 7% multiplied by debt divided by total capital and 16% multiplied by equity divided by total capital. Okay, sir. This will become your WACC, weighted average cost of capital. You can apply this weighted average cost of capital on operating capital employed to find out cost of capital employed. So NOPAT minus cost of capital employed is EVA. You can easily find out by using this formula. So 881 lakh from my point of view is EVA, economic value added. Okay, sir. Done. Coming to the next question. Now, next question, briefly explain the various category of capital as mentioned in integrated reporting framework issued by IIRC. You can refer our book, our institute book for this particular question. I will not discuss. 8A and 8B are also a theory question. You can refer the respective book. Briefly discuss the role of public account committee. Very expected question. This is super expected question. Have been asked in exam. How was the Government Accounting Standard Advisory Board constituted in India? This is also expected only asked. I think you have written. The last. This is for what? Ind AS 110 for changes means for the proportionate changes in NCI. On 1/4/2024, A Limited acquired 90% shares of D Limited for rupees 10,80,000 when the fair value of D Limited net asset was 10 lakh. During the period from 1/4/2024 to 31st March 2025, D Limited made a comprehensive income, total comprehensive income 2 lakh. Means net asset at year end will be 10 lakh plus 2 lakh, 12 lakh. That too you have understood. On 31st March 2025, A Limited sold 15% holding to outsider for 2,20,000 but retained control. Past journal entry in consolidated finance statement because it is a sale of equity shares, means disposal of shares without losing control. So what will be journal entry? Bank account. How much proceed received? 2,20,000. To NCI. NCI will be how much? It is 10 plus 2, 12 lakh. So 12 lakh multiply by 15%. 12 lakh multiply by 15%. It will be 1,80,000. Difference will come how much? 40,000. And that will be transferred to other equity. This is the journal entry. Super easy. Same answer has been given. You can refer. I have given the same answer. Okay, sir. All the discussion has been done. I hope you have understood all this point. Now, if you have any doubt regarding any question, whatever solution I have given, you can comment in the comment box. I will give the clarification for that. One disclaimer is that whatever solution I have given, there may be some difference between my solution and institute solution. We will wait for the institute suggested solution. Okay, sir. There may be some difference because what assumption I am taking, what institute assumption is taking, that might be different. But if there is some error in my solution, you need to forgive me because I am also thinking there might be some mistake done by me also, committed by me. So for that you need to forgive me. But this is my solution. I think the best solution which I can give you, so that before result you can analyze how much marks you can gain, how much marks you can score. For that purpose we have just given the solution to you. Okay, sir. Once again, if you have any queries, comment in the comment box. How was the entire discussion? That also you comment whether it has helped you or not. This entire solution will help the student who are appearing for June 2026 exam also. This time I feel the question paper was good. It was a combination of some question directly from institute book, some question were modified. Whenever any questions are modified in exam, some problem will arise because modified to your entire concept need to be applied for that. Okay, sir. Yes, sir. Now, one announcement I just want to keep that I have already started my one new recording for June 2020 exam. Details of which is already given to you. If you want the full details of the batch, you can listen one video which I have already recorded. The details of that video has been given in the description of this particular video. However, the batch is already started from 7th of December, applicable for June 2026 and onward item. For the first time, I am recording one batch for CFR fully as per ICMI syllabus, focusing on CMA student. Means in this particular batch, I have taken no recording from my CA final recording. Got this point? Means entire recording has been done as per CMA ICMI syllabus. Okay, sir. Yes, sir. I hope this batch will really help you to prepare for CFR exam. All the best for your examination result. All the best for the student who are appearing for June 2026 exam. Bye bye. Love you all.